Vanguard funds are a favorite among investors who value low-cost index funds, particularly for long-term buy and hold strategy. Two popular ETF options are the Vanguard S&P 500 ETF (VOO) and Vanguard Total Stock Market ETF (VTI). They are both known for their simplicity, low fees, and wide market coverage. Both ETFs are excellent building blocks for a long-term portfolio, suitable for all types of investors, from beginners to seasoned pros seeking low-cost diversification. But which one is right for you? In this video, I break down in simple language VOO and VTI, comparing cost, performance, and key differences to help you choose the best fit for your investment strategy. As stated earlier, VOO and VTI are two of the most popular options for investors seeking broad exposure to the U.S. stock market. While both funds offer a similar investment approach, they have distinct differences in terms of their market focus and diversification. Both ETFs provide you with diversified exposure to a wide range of U.S. companies, making them great choices if you're looking to invest across multiple sectors. Despite their different scopes, both funds follow a cap-weighted approach. This means companies with larger market capitalization receive the most significant allocation. This results in both funds being dominated by mega-cap stocks like Apple, Amazon, and Microsoft. One of the main appeal of both VOO and VTI is their exceptional low expense ratios at just 0.03%. Both ETFs are highly cost-effective, making them ideal if you want to minimize fees and maximize returns. But there are some differences. The primary difference between both funds is their market coverage. VOO specifically tracks the S&P 500 index, which includes only the 500 largest U.S. companies, so the focus is solely on large-cap stocks. In contrast, VTI tracks the CRSP U.S. Total Market Index, providing exposure to the entire U.S. stock market, including large, mid, small, and micro-cap stocks. While both funds are diversified, VTI offers broader diversification by including companies of all sizes, from large corporations to smaller emerging companies. VOO, on the other hand, is less diversified since it focuses only on large-cap stocks, and so it provides a narrower exposure. The performance of VTI and VOO can vary depending on the market conditions of their underlying indexes. VTI may experience slightly higher volatility because of its inclusion of smaller cap stocks, which tend to be more volatile than larger cap stocks. On the other hand, VOO, with its focus on large cap companies, generally offer more stability, but may miss out on some growth potential from smaller, more agile firms included in VTI. When comparing Vanguard Total Stock Market ETF (VTI) and the Vanguard S&P 500 ETF, both funds offer competitive expense ratios and impressive returns. Here is a breakdown of three key metrics: assets under management, expense ratios, and performance. Both ETFs manage substantial assets, with VOO slightly leading in terms of asset under management at $498.5 billion compared to VTI's $421.1 billion. Both VTI and VOO boast extremely low expense ratios of 0.3%, making them cost-effective options for investors focused on minimizing fees. Over the past 1, 3, 5, and 10 years, as you can see here, VOO has consistently outperformed VTI by a smaller margin. While VTI provides broader market exposure by including small cap stocks, VOO's focus on large cap companies in the S&P 500 has delivered slightly higher returns over these time periods. As you can see here, VTI offers broader diversification including small, mid, and large cap stocks, but this has resulted in a slightly lower return over the past decade compared to VOO, which focuses solely on large cap companies. The reason lies in VTI's inclusion of smaller cap stocks, which can be more volatile and hasn't performed as well in recent years. However, it's important to remember that historically, small cap stocks have outperformed large cap over the long term. If this historical trend repeats, VTI may offer stronger growth potential in the future, and the recent outperformance of large cap stocks as seen in VOO may not continue in the next decade. Both VTI and VOO are excellent options for investors looking for broad market exposure. So what's the final verdict? Both VTI and VOO are excellent options if you're looking for broad US stock market exposure. If you prefer more diversification, VTI may be the better choice, as it includes all of VOO's large cap holdings plus mid and small cap companies. However, if you're comfortable focusing on large cap companies or plan to diversify with other funds, VOO could be a suitable option for your portfolio. If you like this video, you'll also like this one on the top 10 dividend ETFs, linked also in the description. Be sure to like, share, and subscribe to Financially Well. Let me know your thoughts in the comments below. And as always, stay financially savvy. See you in the next video.